Welcome to the deep dive. Today, we're really digging into something fundamental for, well, any long-term investor. How do you actually protect your buying power?
Yeah.
Shield it from the constant nibbling away by inflation.
Hmm.
We're zeroing in on dividend investing, but, and this is important, with a very specific focus.
That's right. Our mission here isn't just about getting paid dividends. It's about finding income that grows, and crucially, grows faster than your money loses value.
Right.
I mean, think about it. If inflation historically eats up, say, around 3% of your capital's value each year, well, then a dividend that grows slower than 3%. It's kind of like you're running on a treadmill, slowly falling behind.
So right off the bat, we're saying forget just chasing the highest percentage yield number you see advertised.
Exactly.
That number might look fantastic today, maybe it's 6%.
Yeah.
But if that actual dollar amount doesn't increase much,
Yeah.
then fast forward 20 years, and what that 6% can actually buy you in the real world, it might be, 30% less.
Yeah.
That's the core problem we're trying to solve, isn't it?
It is. It's all about the growth. And our research points towards two main ways investors tackle this, two main strategies.
Okay.
First, there's the idea of pairing. Basically, you combine a steady, high-yield stock, your anchor, with other companies that are all about fast dividend growth. Your rockets, so to speak.
Anchor and rockets. I like that. And the second way.
The second strategy is trying to find that sweet spot, a single stock that gives you a decent starting yield and strong growth all in one package, more of a balanced approach.
Got it. Okay, but before we jump into those strategies, I think we need a baseline. Like, why is just high yield alone not enough? We need an example.
Yeah, definitely. Let's look at a classic stable income play, Realty Income, ticker O.
Oh, the monthly dividend company. Everyone knows O.
Exactly. It's the poster child for reliable income. Huge REIT. Real estate investment trust owns thousands of standalone commercial properties. Think drugstores, convenience stores, leased out long term. And right now the yield looks pretty good, around 5.5%.
Okay, 5.5%. That sounds like it easily beats that 3% historical inflation number we talked about.
Mm.
So what's the catch?
The catch is the growth rate of that dividend. We looked back over the last decade, and its annualized dividend growth was only about 3.6%.
3.6%. So yeah, technically beating 3%, but just barely.
Just barely. That's the point. The actual buying power of that dividend check, it's only increased a tiny bit over 10 years. It's like treading water, maybe taking a tiny step forward. This really shows you the hidden cost of slow growth.
Okay, let's make that tangible. Can we maybe run some quick numbers just to show the difference between, say, 3.6% growth and something faster over the long haul?
Sure, yeah, let's do that. Imagine you get a $1,000 dividend payment today.
Okay, got it. $1,000.
Now, if that dividend only grows at Realty Income's pace, 3.6% a year, for 20 years, your annual payment would eventually grow to about $2,019.
Okay, so it doubled, roughly.
Right. But now let's say you had put that money into a stock where the dividend grew at 11% per year, and we'll talk about a company like that later. That same $1,000 initial dividend, after 20 years at 11% growth, it would be worth over $8,062 annually.
Wow. Okay, that's a huge difference. $2,000 versus over $8,000.
That's the power of compounding growth. That gap is the real measurable impact of choosing faster growth over just okay growth.
It's why we argue you have to look for that acceleration.
That perfectly sets up strategy one then. Pairing for power. So if Realty Income is our stable, maybe slightly slow anchor, how do we add that growth? We bolt on companies focused purely on boosting their dividends fast enough to really crush inflation.
Exactly.
Yeah.
We're looking for really high-quality businesses where maybe the current dividend isn't the main story, but their growth engine is just phenomenal. And the top candidates that came up in our research here were MasterCard and Cintas.
Okay, MasterCard first.
Okay.
MA, everyone's got the card, but the business itself is more interesting.
Oh, absolutely. It's one of the giants in payment processing globally. They don't actually lend money, remember?
Right, they're the toll road. Perfect analogy. They take a tiny slice, a small fee, every time someone uses a card with their logo. They're the network in the middle.
And that network.
Yeah.
It's incredibly hard for anyone else to replicate, right? That's the moat people talk about.
Precisely. Think about it. You need the global infrastructure, the technology, the agreements with millions of merchants and banks, the regulatory approvals, and just sheer brand trust.
Yeah.
Building that from zero, almost impossible. And that massive moat gives them pricing power, which lets them generate tons of cash to reinvest in growth, and, importantly for us today, grow that dividend.
And the dividend track record shows that, what was it, a 14-year streak of increases?
Yep, 14 years, and the average annual growth over the past decade was around 20%.
20%. That's enormous inflation protection. But let me push back a bit here. That 20% was driven a lot by cash disappearing and cards taking over, right? Isn't that slowing down, especially in places like the U.S.? Are we just looking in the rearview mirror?
That's a really fair question. And yes, in mature markets like the U.S., card penetration is high. But MasterCard's growth story isn't just about the U.S. anymore.
Okay.
It's massively international. Think about developing economies where cash is still used for almost everything. Huge runway there. Plus, they're pushing hard into things like business-to-business payments, cross-border transactions, value-added services, areas with potentially higher margins.
So, new avenues for growth beyond just consumer swipes.
Exactly. So maybe 20% annual growth slows a little, but that fundamental shift away from physical cash globally, that's a tailwind that's going to last for years, probably decades. Plenty of fuel left in the tank.
Makes sense. But, like we said, the trade-off for that kind of growth, the current yield is tiny, like 0.5%.
Very small starting yield.
Yeah.
Which brings us to the other partner in this pairing idea, Cintas. Yes.
Cintas, totally different business, industrial services. What do they actually do?
Yeah. Think uniforms. Businesses need uniforms for their staff. Cintas provides them, cleans them. They also do safety supplies, first aid kits, restroom cleaning, floor mats, essential facility services.
So we're saying a company that rents out uniforms could be a better long-term inflation hedge than, say, owning buildings like Realty Income. That feels kind of backward.
It does sound counterintuitive, I get that. But look at how their business works. These services, while maybe a bit cyclical with the economy, are often essential. Sometimes they're even required by regulations like safety gear or specific hygiene standards. So companies have to keep paying for them even when times are tough. It creates a very sticky, reliable cash flow. It's not like selling luxury watches.
Okay, sticky cash flow. But where does that explosive 20-something% dividend growth come from? That doesn't sound like just renting more uniforms.
A big part of it is acquisitions. The uniform and facility services industry is still really fragmented, lots of smaller regional players. So when the economy takes a downturn, those smaller companies often struggle. Cintas, with its strong balance sheet and steady cash flow, can swoop in and buy them up, often at pretty attractive prices.
Right. They consolidate the market during weakness.
Exactly. They integrate these smaller players into their super efficient operations and boom, instant boost to revenue, market share, and ultimately the cash available for dividends. It's a brilliant roll-up strategy.
And the dividend stats back that up.
Oh, yeah. Cintas has raised its dividend every single year for more than 4 decades.
40 years. Wow.
And the average growth over the past 10 years, 22% annualized. Again, huge growth. But just like MasterCard, the trade-off is a low starting yield, currently only about 1%.
Okay, so let's just pause and explain why these amazing growth companies have such low yields. Because someone listening might be thinking, great growth, but 0.5% or 1% doesn't pay my bills today.
Right. It's a fundamental relationship between growth, valuation, and yield. When a company is growing its earnings and dividends really fast, like 20% a year, investors get excited about that future growth. They're willing to pay more for the stock today in anticipation of those higher future earnings. This pushes the stock price up, often even faster than the dividend is growing.
So the PE ratio, the price to earnings, gets high.
Exactly. The stock price might jump 25% or 30% in a year, while the dividend grew only 20%. So mathematically, the yield, which is the annual dividend divided by the stock price, actually gets squeezed lower.
Price goes up faster than the dividend payment does.
Precisely.
Right.
And that's why the pairing strategy makes sense for some people. You use something like Realty Income for that higher immediate income. That 5.5% yield helps pay the bills now. And then you add the MasterCards and Cintas to provide the growth engine, ensuring the total buying power of your portfolio keeps pace and hopefully outpaces inflation over the long run.
Okay, that makes total sense.
Yeah.
Strategy 1, pair stability with growth. But that brings us nicely to strategy 2, the balance. Is it possible to find, the holy grail, one stock that does both reasonably well, avoids the complexity of pairing?
It is possible, yeah. But you usually have to accept a compromise, right? You won't get the absolute highest starting yield, and you might not get the absolute fastest growth. You're looking for that middle ground.
The sweet spot.
The sweet spot. You need a company that has like 2 parts to it. A really stable cash cow kind of business, funding a clear, strong growth engine that's bolted onto it.
And the prime example you found for this?
The best one we saw fitting this description was Next Era Energy, ticker NE.
A utility. Okay, normally we think of utilities as slow and steady, maybe boring income plays, not growth machines.
Traditionally, yes, but NextEra is different. Let's look at the numbers first. The current dividend yield is around 2.8%.
Okay, 2.8%. That's definitely lower than Realty Income's 5.5%, but it's way better than the S&P 500 average, which is like 1.2%, 1.3%.
Exactly, almost 3 times the market yield. But here's the kicker, going back to that math we did earlier.
Yeah.
The dividend growth rate. Over the past decade, NextEra has grown its dividend by an average of 11% per year.
11%. Okay, now that's interesting. Decent yield plus double-digit growth. That feels like it hits both targets.
That's the balance we're talking about. It's potentially offering real inflation protection, all within one stock.
So how do they do it? How does a utility achieve 11% growth? Where does the stability part come from?
Okay, the foundation, the stable part, is their traditional regulated utility business in Florida. Florida Power and Light.
Right. Big state, lots of people, growing population.
Huge state, lots of sunshine, lots of air conditioning, and crucially, it's a regulated utility. That means they get permission from the state to earn a predictable, set return on the money they invest in power lines, power plants, etc. It's slow, maybe a bit boring, but it generates very reliable cash flow. That's what supports the 2.8% dividend baseline.
Okay, that's the anchor. Where's the rocket? Where does the 11% growth come from?
That comes from the other side of their business, a division called NextEra Energy Resources. This part is all about investing in and operating renewable energy projects, wind farms, solar farms. NextEra is actually one of the biggest developers and operators of solar and wind power, not just in the U.S., but globally.
So they're taking the steady profits from the Florida utility and plowing that cash into building out massive renewable energy infrastructure.
You got it. They're using the guaranteed income stream from the regulated side to fund, at enormous scale, the huge capital investments needed for the green energy transition.
And if you connect that to the bigger picture, I mean, the shift to cleaner energy isn't just a fad, right? It's happening everywhere.
Absolutely. This isn't some short-term trend. It's a multi-decade global shift. Governments, corporations, everyone's pouring money into decarbonization.
So that provides a really strong long-term tailwind for that growth part of NextEra's business.
Precisely. It suggests that their 11% dividend growth isn't just a historical fluke. It could be quite sustainable for years to come. It puts NextEra right in that attractive zone, that sweet spot between getting paid decent income now and getting strong income growth to protect you down the road.
This has been really insightful. A true deep dive into making your income work harder against inflation. We've seen that just chasing yield isn't enough. You need growth. And we've explored two main paths. The pairing approach anchor, like Realty Income, rockets like MasterCard or Centus, or the balancing approach, finding that all-in-one like NextEra Energy.
Yeah, the key thing to remember really is that dividend investing, when you're thinking long-term, it's fundamentally a race against inflation. You're essentially betting on a company's ability to grow its earnings and therefore its dividend payout faster than the value of your dollar shrinks.
So the main goal, like we said at the start, is truly protecting your buying power over decades. Let's leave our listeners with a final thought to chew on. A provocative question, maybe.
Okay. We've looked at two very compelling ways to build long-term defense. There's the Syntest model. 40 years of consistent dividend increases, proven operational excellence weathering multiple recessions. Is that track record the ultimate sign of long-term security, that reliable rhythm? Or is the better guarantee found in tying your investment to an unstoppable decades-long trend, like the global shift to renewables that powers next year's growth? Is hitching your wagon to an inevitable future macro shift the more secure bet for protecting your income down the line?
History versus the future, in a way.
Kind of.
Yeah.
Proven consistency versus arguably guaranteed structural change. It's a really interesting philosophical choice for an investor focused on that long-term inflation protection.
Definitely something to think about as you build your own inflation defense. Thank you for joining us for the deep dive.